What are mortgage interest rates? When you take out a mortgage, you are borrowing money from a lender to buy your home. In return for letting you borrow the cash, the lender charges you interest that you pay back as you go. The higher the interest rate, the more you'll pay back to the lender over time. The rate you'll be charged will depend on a number of factors, such as the amount you borrow, the size of your house deposit, the type of mortgage you get, your credit history, and the offers that the lender has available. Your interest rate can also be influenced by wider market changes, such as the base rate set by the Bank of England. What is a typical mortgage interest rate? For more than a decade, it was typical for a fixed mortgage interest rate to be around 4 to 4.5%. But during the pandemic, you could find low rates between 1 to 3%. We even saw a sub 1% interest rate. This made it easier for first-time buyers and remortgagers to take out large loans without having to think too much about the amount of interest they'd pay overall, or how much their monthly repayments might be, impacted by future rises. After the mini-budget, mortgage interest rates rose to 5 to 6%. Now in early 2023, we're seeing interest rates return to pre-pandemic levels, with some lenders even releasing fixed rates below 4%. What are the types of mortgage interest rates? A fixed rate mortgage is a type of mortgage where you'll fix your interest rate for a certain number of years. This is known as the product term. Your product term may be 2, 3, 5, or even 10 years. The length you choose is up to you. Fixing over a longer period gives you certainty that during that time, your monthly mortgage repayments won't increase, no matter what's happening in the rest of the world. However, it does throw up the risk that if interest rates reduce during the period, you might be overpaying versus live market rates. Typically, there would be an early repayment charge or penalty if you exit your fixed rate early. A variable rate mortgage, as the name suggests, is a type of mortgage where your interest rate won't be fixed, so your mortgage repayments may rise or fall from one month to the next. There are different types of variable rate mortgages. These include base rate tracker, discount variable rate, and standard variable rate. A base rate tracker mortgage tracks the Bank of England's base rate. If the base rate rises, your interest rate and therefore your repayments will rise too. If the base rate falls, your interest rate and repayments will follow. For example, a base rate tracker mortgage might track at 1% above the Bank of England's base rate. If the base rate is 2%, this means your interest rate will be 3%. If the base rate falls by 1%, your interest rate will do the same. A discount variable rate mortgage is when your interest rate is set at an amount below your lender's SVR for a set period of time. Should I choose a fixed rate or variable rate? Both products come with their risks and advantages. It's very important to seek expert advice when considering taking out a mortgage. Put simply, a fixed rate mortgage can be ideal if you're looking for stability and you want to know exactly how much your mortgage repayments will be each month. However, fixing your mortgage interest rate could see you paying over the odds if rates fall during your product term. For example, you might fix your mortgage at 5% because you're worried about further increases, only for rates to fall to 3%. That 2% can make a big difference over the course of your mortgage. When you fix your mortgage, you essentially pay a premium for the benefit of knowing exactly how much your repayments will be. When it comes to a variable rate, you'll need to have some appetite for risk. You won't know what your monthly repayments will be, so it's important that you play out a few scenarios to see if you'd be comfortable with a 2% or 3% rise. If you're not, that's a sign that a variable rate might not be right for you. However, typically, interest rates on variable deals are much lower, and with some carrying no early repayment charge, for those with a risk appetite, they can be an attractive option. How can I find the best deal? When choosing between different mortgage rate types, it's always best to get expert advice from mortgage brokers to work out the best option for you. They'll compare hundreds of lenders and mortgage products from across the market, saving you time, effort, and money. In fact, here at Tembo, we advise on over 100 lenders and thousands of mortgage products. To discover the best mortgage rate deals for you from across the market, head over to tembomoney.com. Let's make home happen.